Hello and welcome. You are watching News 9. I am Ashish Maheshwari and to my right is Shweta Kothari. And you are watching Business Plus, where we cover stories from the world of business, policy and economy. As always, let's start with taking cues of the market mood this morning. Now, after a 1% fall in the last 2 days, Indian markets saw a bounce back amid positive handover from US equities. Indian markets in fact saw a gap up opening where Nifty was up about 100 points and Sensex gained as much as 350 points. Now US markets snapped its 3-day losing streak yesterday with Nasdaq rising as much as 1% after US 10-year bonds eased slightly. Also a fall in crude prices as well as lower than expected jobs data, the private jobs data in the US lifted sentiment for the equities as talks about a higher rate regime for a longer period has eased, and as a result we saw a bounce back in the Indian markets also, Shweta. Now Nifty currently is trading above the 19,500 levels, which was and
back
has
at
been
its crucial support
level, and whereas Sensex has scaled about 360 points this morning and it is trading about 65,587 points thereabouts.
All right. So
now the broader markets, Shweta, have also been buoyant. Now they saw a correction of over 1%. Nifty mid cap was down about 1.5%, whereas small cap index corrected by 2%. Today morning the small cap index is up about 1% or so, and the Nifty mid cap indices, mid cap 100 is up about 0.5% in the morning trade.
all right, so that's as far as markets this morning is concerned. A gap up opening in the markets. Is this a rally? Is this a much awaited rally? I mean, come to think of it, 0.5% down as of closing day yesterday, 0.5% up today. Markets are beating perhaps all estimates. We had a very important guest, Mr. Baliga, Ambrish Baliga, on the show yesterday, who's in fact in a way predicted that markets are going to touch 18,000 mark. Nifty is going to touch 18,000 mark before it scales up to 20,000 once again. Ashish Maheshwari, I'm told, who's the director at Arihant Capital, joining us on the show at this point. Ashish, good morning. Thank you for taking time. I think first question that is weighing on everybody's mind is, what are you making of this sharp bounce back and volatility?
I think whatever is happening in the global market, we are aligned or in sync with that. So we have seen in last 6 trading sessions, if you see, almost 13,000 crore worth of equities are sold by FIs. And if this momentum will not continue, I think again there will be seller. And if you see the US bond yields, etc., also there's a lot of pressure in the portfolios of US fund managers also to book gains or to liquidate positions, because the bond prices, the way bond prices are going down, they have to liquidate some of their holdings for sure. And emerging markets are the one where they have made money, so some liquidation is coming. We have seen in the last month also a lot of deliveries were sold in cash market, and I'm expecting same trend will continue unless this rate hike related fear subsides in US market.
What are you making of this 0.5% movement and 0.5% up movement one day and 0.5% down movement that's playing out in the markets for the past 4 days? In Friday's session we saw a 0.5% rise. In the last 2 sessions the market was down 0.5%. Today it's up 0.5%. What are you making of this sharp up moves and down moves in the market?
So this is something like this kind of volatility is happening on account of FI selling in the market. Yesterday also we saw almost 4,000 crores worth of equities they dumped in Indian market, and whenever they sell, they mostly selling come in the basket format. So the impact is quite high. So this kind of volatility will continue because as such there's no domestic triggers also which can keep our stock market going, and unless now because the result season will start. So some momentum is going to be there in individual stock specific stories, but overall still I'm of the view that FIs won't stop selling Indian equities in a short period of time. They will continue to sell.
All right. And how about longer period? When do you see FII's interest coming back to India?
If you see, even all the FI brokerages are, if you see Nifty 50 stocks, almost 80 to 90% are buy side recommendations, be it Jefferies or Morgan Stanley's or you name it. They are all bullish as far as individual stocks are concerned, but this is something like beyond the control, because when you are having a lot of payout you have to make out of your investments in US market, you have to liquidate somewhere. So they are not selling by choice, but I think by compulsion. So we need to just wait and watch because there's some issues related to interest rate hike in US markets, and once there's comfort in the street that now a rate hike is going to pause, then you are going to see fresh inflows in their funds, and at the same time they will again start buying into Indian equities. But till that time, we need to just wait and watch.
Now, Ashish, we saw a 5% or so crash in Brent crude prices after OPEC Plus decided to maintain its output policy, and Russia and Saudi said that it will extend its cut of about 1.3 billion barrels per day. So there were talks that perhaps there could be more cuts in the offing. As far as at least now, OPEC has come out and said that it will stick to that path. And also the yields came off that 16-year high. So it seems that there is some sort of a relief there. Perhaps that's why the market saw that 0.5% up move today.
Yes, there's the solace at last. The crude, which was almost at $95 for quite some time, has again touched $85, which is a comfort mark as far as Indian markets are concerned. And this slight 15 basis point retracement in bond yields is also something that market is playing for by trading in green. But only thing is till how long this is sustainable, at least the bond yields, which need to be seen. As far as crude is concerned, I don't think so now we are going to see $95 back in Zifi, because the way employment data is expected from US markets, demand for crude is expected to go down only. So I think now next territory for crude trading should be $82 to $92 instead of 85 to 95.
So perhaps a correction of about $5 instead of scaling back that $90 levels. Also,
and this augurs well for India. Come to think of it, Ashish, India, I think the comfort zone that oil minister has constantly maintained is about $80 to $85 a barrel. If the oil prices were to come back within that range, it augurs well for India.
100%, because India is major importer of oil products, and if the oil prices remain in this territory, you don't need to increase retail oil prices at all. At the same time, in wholesale prices also will be under check. And we should not forget this is an election year, so retail fuel prices, I'm not expecting that they will go up. Only some tickering in LPG prices, etc., will keep on happening. But surely, if wholesale fuel prices goes up, then this is again a problem with the inflation numbers. At this point of time, government is they're doing all proactive steps to tame the inflation hike. So, in my view, our interest rate will remain in this particular territory. I'm not expecting any rate hike, etc. So, crude is an important factor for everything. So, if crude remains in this territory, I think this augurs well for India.
So better inflation, perhaps a longish pause and a rate cut subsequently at some point of time, Ashish, if not this time around. And since MPC, announcement will be made tomorrow, your expectation from what I'm reading is that it's going to be a pause, a hawkish pause?
Yes, a hawkish pause is something like that market is also expecting. And it's going to be there because there's no need to, in fact, do a rate hike as such, because the vegetable prices and the food prices are under control now. And even electricity demand has also come down. So you are going to see some moderation in inflation going forward instead of rise in inflation now onwards. So I'm expecting a pause this time and maybe a rate cut in the next policy.
Okay.
So you
rate
expect
cut
a rate cut in the next policy?
That's very
actually
soon.
quicker than the timeline that a lot of analysts are pitching in, because they expect the rate cuts to set in probably in the second half of the next calendar year.
And some of them not expecting, at least in this financial year. This is as quick as it gets. So you just to reaffirm what you said, you're saying there could be a rate cut by next policy?
So again, the rationale is if the inflation comes down, see, because we are a growing economy and lower interest rates are good for the our growth as such. So, and one important thing is again I'm reiterating, this is an election year. So government will not like that the interest rate will go up and unnecessary middle class and lower middle class face the brunt of higher interest rate. So this is the reason that like I'm taking a call, and that sooner or later you might see some dip in the interest rate cycle, because if inflation is under control, there's no need to keep those higher rates in the economy.
Okay, I'm
But,
still
I mean-
hoping MPC will take that decision independent of the government pressure, what government wants. So hopefully, and knowing that RBI is a standalone institution with its own autonomy, hopefully will take a policy call based on what inflationary pressures the country is facing, as opposed to the government pressure that it will face on account of election.
Yes, and to that point, I mean, one of the reasons why we are seeing, heightened inflation is probably because of government front loading the capex cycle ahead of the elections. So RBI keeping the policy rates higher to, lower the inflation, whereas government is spending more, which is pushing up the inflation. So fiscal policy and
the
monetary policy
quite in contradiction with one another.
Ashish,
All right.
is
Yes,
there
I
a
agree.
play there?
For sure, government is pushing their capex, and the kind of budgets they are having for capex in this year in almost all sectors, be it defense or railway or power or infrastructure. I think they will keep some pressure on inflation, but one thing we must understand, if you see the demand for steel, cement, etc., it is going to pick up, but the prices are not going up, because the kind of expansion our Indian companies have done in last few years is keeping price under check. Besides this, there is not too much export demand also, as far as all these industries are concerned. So everything is consumed in India, well, without hurting the prices, or without hurting any capex plan. So I think this will continue at least for 6 months. I am not expecting steel, copper, aluminum, or cement prices will go up at least in next 6 months. And this is the reason I am quite bullish as such in overall sentiment, that because of this, interest rate will come down sooner or later.
Now, as you said, you are bullish on the India story in the short term as well, and you expect crude prices to moderate to, moderate further to about $80 a barrel, inflation cooling down. All that augurs well for the Indian markets. But, we have had Mr. Amrish Baliga yesterday, who was of the opinion that perhaps Nifty and the headliners could see some more weakness coming over the next couple of months, and Nifty could, break past that 19,000 mark and fall as much as 5% to 18,500 mark. So in light of all this, what sort of a probability do you think is there that the market sees a correction of 5% or so play out in the next couple of months?
I mean, do you even agree with that to begin with? Do you even agree that there could be a sharp 5% fall?
If you see it from 19,500 to 19,000, this is hardly 3-4% mark. So this kind of fall, gain or loss are quite possible when you are sitting at 19-20,000 indices. So I'm not going into much what may happen in 19,000 or what will happen in 20,000. I think this all depends on how this quarterly numbers comes. And I'm not expecting any weakness as far as this quarterly number comes. So you will not keep on dumping stock in spite of good numbers in if these companies come out with. And I'm expecting Nifty companies will come out again, good set of numbers, be it IT or oil and gas or banking sector. They will come out with good set of numbers with this in this quarter. So I'm not that bearish. In my view, maybe 19,200 kind of mark in Nifty can be a good support or even a good accumulation zone at this price point.
Ashish, you mentioned that IT could, come out with a good set of numbers in Q2. But, the commentary that came from Accenture last week suggested that discretionary spending has perhaps not picked up just as yet. And, even the smaller projects are facing delays. But in contrast, we have seen, at least the bellwether companies like Infosys, HCL, Tech and TCS land billions of dollars of worth of contracts in a span of couple of months. So do you think that Indian IT sector could outperform the global IT sector, and if so, what, like on what basis pretty much?
First thing is these IT companies, whatever we are having the top IT companies like Infosys, HCL Tech, Wipro, Infosys, etc. They are having long-term contracts and they are more into the support operation of an organization. So, like they are implementing the ERP, they are implementing the digital transformation process, they are maintaining their back-end operations, etc. So, if an organization is doing business, they have to take services of these companies. So, this is the reason, in spite of last quarter, weak commentary, still they were able to come out with some really good deals as such. So in my view, like whatever the last quarter weakness was there, slightly we need to discount this, and we are going to see some moderate growth also in this quarter. Another thing which has happened for mid-cap IT companies, in mid-cap IT companies, they are operating very niche areas of working like automations or AI or machine learning or digitalization, etc. So your companies like again KPIT, Tata Elxsi, etc. They will also continue to do well because they are very focused and operating not in 20, 30 verticals, but 5, 6, 7 verticals where growth is there, and they are having long-term arrangements. So this is the reason, in my view, this sector will continue to do well and should be in our buy radar.
Now, I also wanted to get your view on the banking SPAC, specifically HDFC Bank. Now, in yesterday's fall, where we saw a 1% correction in Nifty Bank, HDFC Bank was the only constituent stock that did not fall. In fact, it went up by about 1.5%. And HDFC Bank has been a major drag on Nifty and Bank Nifty. And in the recent correction, I think it has attributed to about 192 points of fall. But after yesterday's pickup and the management rejig is also happening, do you expect that perhaps there is a time that HDFC Bank could perhaps make a turnaround in the next few days, sessions or weeks, and it could drive Nifty Bank and Nifty higher from here on?
Yes, I think HDFC Bank along with Reliance was major culprit of bringing Nifty down. And now at 1525, 30 levels, there is a lot of value now in this stock. And if we saw their last quarterly updates also, they were quite robust. In fact, besides home loan, significant growth, again, wholesale banking and corporate banking has also grown quite a bit quarter over quarter. So, in my view, worst is now priced in HDFC Bank. Another issue was with HDFC Bank post this merger. Again, a lot of selling was happening from foreign institutional investors. But at the same time, we have seen again gradual accumulation happening in the stock from DIA side also, because ultimately value is there in the stock. And we have seen upgrades also from foreign brokerages now in this stock with 2000 plus targets coming in HDFC. So, in my view, you have to start accumulating such stocks where fundamentals are strong, but because of excess supply, stocks have fallen. So, this is a good price point to enter into HDFC Bank.
Now, as we are running short of time, I also want to touch upon the World Cup. The World Cup starts today. A lot of sectors, related sectors like hotels, QSR segment, and also the consumption theory has picked up and has rallied. In fact, the hotel sector has been one of the outperformers in the last few months, as the average room rate has gone on off the roof. And I was reading a report where it suggested that, you know, in cities where matches are going to be played, the average room rate has spiked up as much as 150%. So given that, you know, the revenue, at least guidance, looks good for these hotel companies, do you think that the expectation of the World Cup and, you know, subsequent festival season and the wedding season that also kicks off in a couple of months has already been priced in, or is there a play that investors can make at this point in time?
I think this is a sector which will continue to do well. We have seen in the last quarter also the numbers were pretty robust for all these hotel stock or QSR companies, etc. So again, as consumption is picking up, as far as World Cup is concerned, again the hotel stocks are going to be in limelight, because assume there will be a crowd of 45,000 in a stadium, and at least 5,000 people if they start traveling from various countries or various cities, etc. At least you require 2,000 room in cities like Bangalore or Chennai, and that too in decent size hotels. So rooms rates are going to surely go on the roof, and this is going to benefit a lot of companies like Lemon Tree Hotel or EIH and Indian Hotel, etc. So I'm quite bullish as far as hospitality industry is concerned. Though there will be some pressure related to crude prices on aviation stock, otherwise interglobe aviation can be also kept on radar now.
All right, Ashish, thank you very much for taking time out. Thank you for joining us this morning. We, of course, are keeping a close watch on World Cup. We continue to track all the developments there as well. And to you too, Suyash, thank you very much for taking time out. It's time to move on to a story that we're tracking since yesterday. SEBI Chairperson, the first female chairperson of Securities and Exchange Board of India, has spoken on a variety of issues. She was, of course, talking at the RIA conference, where she talked about mutual fund industry, talked about registered investment advisors. My colleague Karthik Malhotra joining in to perhaps discuss some of the highlights of her speech. But I think what stood out for me was that not all people you're taking your investment advice from are actually registered. In fact, 1 of 3 are not registered investment advisors.
Absolutely right, Shweta. So I think startling numbers there. Almost 35% or so of investment advisors are actually not RIAs or registered investment advisors, which means they're offering advice without really going through the process of SEBI of registering themselves and being legally formally allowed to give investment advice. But that's not really what stood out for me. I think that was fairly obvious given the number of YouTubers out there and social media influencers as we call them, dishing out so much advice. I think what really awestruck me was Madhabi Puri Buch actually taking to the stage and having such a lovely informal conversation with the entire RIA community. Not something that we've seen, with her predecessors, including Ajay Tyagi and anybody else in history, and really the colloquial way in which she continued those conversations. So specifically, I think on this whole subject of influencers, she went on and said that, at one level, you are saying that you want the thappa of a government school, but you want to continue taking private tuitions. So, interesting quotes coming in from her there. And I think every one of them pretty much stood out as a gem if you were to look at it. So she's saying specifically on the fee charge mechanism, and this was something that came up during the discussion, and she said that this is a no-go area because this is a PMS territory, and we have our reasons for setting limits on certain fee structures. So I think a fairly candid conversation there. What also I think stood out for me was Mr. Harsh Rungta having a conversation with Madhabi Puri Buch and really seeking this response from her, in which he said that, if you make these entry barriers so high for investment advisors to come in, how do we staff our offices? So if everybody has to take that exam and clear that test and register themselves as investment advisors, our costs really go up. So to that she pointed out very clearly, and she said that, okay, as long as you decide that you will take care and you will take responsibility of every advice given by a non-registered RIA, part of your organization, I'm willing to make the deal with you. So
which is not possible.
Not mincing, yeah, not
Not
possible.
practical at all.
I mean, companies at the end of the day, owners of companies, founders, CEOs of companies have to take responsibility of every action undertaken by that organization and members of the organization. But I think very broadly speaking, you know, she was absolutely candid. She touched upon issues of fee structure. She mentioned that mutual funds are the safest investment tool, the easiest sort of, you know, entry into market-linked investments, and stringent norms there to protect investors. And I think she reiterated multiple times over that our job is only to ensure that investor protection is paramount. And to which, again, one of her quotes very interestingly said that, you know, our job is to tell you this is a khai. And then she left it, that, you know, you want to jump into it, you jump into it, you don't want to jump into it, don't jump into it. But our job is to tell you that there is a khai up ahead and there are dangers, and if you still want to jump into them, it is your call. But our job as SEBI, as regulators, is to ensure that investor protection is paramount.
All right, and our job is to ensure that the investors know of every khai, every ditch that they may encounter on the way.
And they're not going to get any thappa of being a government school and taking private tuitions specifically on finfluencers.
So Madhabi Puri Buch, they're having a candid conversation with registered investment advisors. At the conference yesterday, a variety of commentary coming in there on your screens at this point in time. But shifting focus to a story that we're tracking by the way of UPI and NPCI, not so much as UPI, but National Payments Corporation of India has in fact tied up with UAE's Al Etihad to offer not a UPI service but a Rupay card-like service in UAE.
That's right. So that deal is to be signed today on October 5th. I think historic day there, because we have our Commerce and Industry Minister Piyush Goyal at UAE, and this deal between this agreement between the NPCI International Payments Limited, which is the global arm of the National Payments Corporation of India, and Al Etihad. This agreement is actually going to enable cross-border transactions using the Rupay stack. So the Rupay debit cards and the Rupay credit cards and that entire stack which has been built by NPCI is up for an agreement between the two countries. Now, what is this going to do? Number one, of course, it is going to facilitate cross-border payments. But NPCI International has already initiated that with a host of other countries. This includes our neighbors Bhutan and Nepal, and as well as a close business associate Singapore. So these three countries are already using the UPI stack, the UPI service for cross-border transactions between those three countries and India. Now, Rupay becomes this added extension for UAE. And this stack is again going to be largely, you know, fostering this cross-border transactions, peer-to-peer transactions that happen between these two countries. Of course, there is a large Indian diaspora, you know, in the construction industry, in the oil trade industry, in UAE, even in the banking sector for that matter. And any remittances coming back into India or any transaction being made from India to UAE, if that stack can be the Rupay, and if it is denominated by the Indian rupee, the INR, then obviously the ease of cross-border payments increases multifold. Now, add to this, I think there are also bilateral meetings, you know, scheduled, and these bilateral meetings.
Before you come to that, just a clarity. So, on the Rupay card, if I am an NRI living in UAE, after the Rupay card is rolled out, I can take that Rupay card and make transactions in UAE as well as India?
So, what it seems to me is that it is the architecture being used, not specifically point of service, point of sale, contact-based transactions. That stack is being used, that if you if you're on that stack of Rupay, then you can link your bank accounts to the Rupay infrastructure, and that can facilitate the payment back to India or remittances back to India. Right. But I think as the technology sort of, you know, finds its way deeper into the geography of UAE, even point of sale services should be enabled, and hence an Indian carrying an Indian debit card, a Rupay debit card, traveling to the UAE should be able to make transactions using that debit card in INR. So I think those are the additions that will that the agreement will see.
So we're still waiting for the details.
Absolutely. So I think the MOU is going to get signed only today. Once it is signed, we should have a copy of it and we'll be able to drill deeper into it. But multiple other bilateral trades, ironing out of trade, you know, challenges that the two countries face is up in a high-level task force meeting scheduled today and tomorrow, both the days. Overall, India's trade with the UAE has gone up almost 3 times over in the last 5 years. if you look at the period between 2020 and 2023, March 2023, in this 3-year period, FDI from UAE into India has breached the $17 billion figure, which is fairly substantial. But overall, just about 2% of India's overall FDI into the country in that period. So a small percentage, a large number. I think global partnership, global trade, also with respect to the economic corridor, etc., and all of that getting strengthened is all going to add to trade partnership between the two countries.
All right, and we already have a SEPA agreement with UAE, which has resulted in trade doubling down over the past couple of years. But moving on to a story that we're tracking here in India, it appears that airlines cannot use the IBC route anymore to hold on to the planes that they have leased. This is a big bummer for a lot of airlines. I don't know if it will be applied retrospectively. I don't think that's going to happen. But what happens to an airline that now files for bankruptcy, if at all, in the coming years?
So very simply put, Shweta, I think case in point here being Go First.
Okay.
And Go First filed for voluntary insolvency, approached NCLT, got admitted in NCLT, and NCLT presided over the Cape Town Convention. And the Cape Town Convention says that lessors should be given the right to access their aircraft, if an airline goes bankrupt. But NCLT said that IBC rules are going to prevail, and the Cape Town Convention is not going to be, upheld in this matter, because our IBC rules suggest that if an airline has voluntarily filed for insolvency, then until the matter is resolved, the airline continues to hold the aircraft. Now, this became a concern area for lessors. It became a concern area because they started looking at India and India-based airlines with suspicion and a great degree of concern that, if we were to lease our aircraft to an Indian operator and that Indian operator goes bust, and so many Indian operators have already gone bust, what happens? We can't access our aircraft. We can't lease them to anybody else. And therefore, the cost of leasing should go up, and the risk associated and the risk mitigation should entail perhaps A, much higher pricing to lease aircraft that makes the Indian airline sector in any case more unviable. And B, it suggested that, maybe we'll decide not to lease our aircraft to Indian carriers, because if they go into bankruptcy, we can't access our aircraft back. So now the Ministry of Corporate Affairs has notified that the right to ownership or taking back of the aircraft in case of a bankruptcy proceeding is with the lessors. So I think a sigh of relief definitely for the lessors, also a sigh of relief for airlines which are not heading towards bankruptcy.
How's that?
So, because if their cost of leasing aircraft and the bargaining power that they have with lessors continues to be intact.
Okay.
If lessors were wary of sending their aircraft, leasing their aircraft to Indian carriers, then the cost of operations for non-bankrupt
so you're building confidence with
up.
lessors.
Absolutely. So that, I think, status quo maintained, and more than anything else, I think that faith that, okay, we will continue to get the aircraft as and when we require them, they would be leased to us, and our operations would not get disrupted because lessors get wary of our sort of, legal ecosystem. That fear has gone away. So at one level, the lessors are happy. At another level, even, operators like, I'm sure, Indigo and Vistara, Air India should be happy with
the
this
ones
move.
that are still going strong, perhaps, will have less
Not
worries.
sure how SpiceJet is looking at it, because SpiceJet is also struggling
on the verge
to keep
of
the
bankruptcy, has been dragged into the IBC.
To keep its aircraft afloat. So we don't know how SpiceJet would be viewing it, not very kindly.
All right. Since you mentioned Go First, and in the light of Go First filing for bankruptcy and NCLT categorically saying that lessors cannot have the planes back, there was, as you rightly pointed out, a sense of fear, anxiety towards Indian airlines and probability of a renegotiation of contract. Perhaps that's not going to happen now that lessors know that they will get their planes.
I think this should resolve it. This should pretty much put an end to any speculation or any sort of rebargaining, renegotiating between the lessors and the airline operators.
All right. Good news there for at least lessors at this point in time, and also for existing airline players that are strong, not likely to go into bankruptcy anytime soon. But before we move on to our next story, let me call in my colleague Amit Ranjan. Amit Ranjan, tracking the story of how subsidies, the cooking gas subsidies, are in fact increasing. Cooking gas likely to become cheaper, in fact is now cheaper by 300 rupees.
Yeah, a second increase in, hello Shweta, a second increase in 3 months.
Okay.
In August, the subsidy was increased by 200 rupees. Now it has been increased by another 300 rupees. So for the beneficiaries of the Ujjwala scheme, a cylinder, a 14.2 kg cylinder will now cost 603 rupees. I think you and I are paying around 1100 rupees right now.
I know, I have piped gas
Okay.
coming into my society, so I have stopped tracking LPG prices.
Okay.
Back.
So yeah, so that is, it is election year, so probably expected. This scheme, as we know, is aimed towards the poor families, the women cooking in the villages, to keep them away from harmful smoke that was happening in the chulhas. As we expectedly, this is going to benefit a whole lot of families. 9.6 crore families pan India.
Okay.
The subsidy has gone up almost 26% from 22-23, when it was 6,100 crores that was outlaid for this subsidy. It has gone up to 7,680 crores in 23-24. So almost a 26% increase in 1 year in the amount the government is outlaying towards the Ujjwala scheme.
All right.
So that's how big.
I have to say, another election gimmick. I mean, come to think of it, the direct beneficiary of a cylinder is an average person who does not have access to piped gas like you, Karthik. Essentially, a large chunk of middle class and lower middle class people. This on the back of election, but also likely to have a positive impact on inflation like the last time around.
So I think, Shweta, there is no doubt the first thought that strikes somebody is, oh, election year, another subsidy, another revdi, another SOP, another, price reduction, great. But I think at another level, it is also a social contract that governments have with the larger population. And that social contract entails that at a time when inflation is high, and you're not really able to tame it for whatever reasons, there is need to ensure that there isn't excessive cash spent by those who cannot afford it. So the essentials they will still need to procure, they will still need to buy, but if we can offer some sort of a subsidy to reduce the overall impact of inflation by giving a revdi or a subsidy somewhere else, then overall that social contract gets fulfilled. I mean, we had seen this even during the start of the pandemic, when free ration was to be given to below poverty line segments of the society, of the country. There wasn't any election underway then, but it is your social contract that there is a shortfall, there is an income trap, there is this reduction in income, job opportunity, employment, etc. You still got to ensure that that the country, the citizens of the country do not really overspend and are able to continue living their lives and thriving in their existence.
But
so
from last time around, when government increased subsidy by 200 rupees to now when it's increased 300, there is very limited data to suggest that inflation has gone up. September numbers are not out just as yet. So timing is a suspect.
Inflation is going up. It is just, what is inflation? Inflation means prices are going up. They are not going as high at a rate as high as it was 3 months back, but inflation suggests prices are going up. I'm not discounting the election, angle narrative at all.
Okay.
But I'm saying there is also, you increase subsidy today, perhaps also on the back of knowing that there is a likely crude price increase up to $100 per barrel, which will directly have an impact on gas and oil companies. So prices may increase in any case, but that subsidy is offering a bit of a cushion to that likely increase in prices, but cannot discount the fact that it is election year, it is election season. You want to keep the people who are going to vote for you happy. And what better way by rather than putting more money in their hands?
Let's give more SOPs and more revdi.
Keeping that in mind, the subsidy is only for the 14.2 kg cylinders. The 19 kg cylinders, which is used more by the commercial, there is no subsidy. That will play out as crude oil prices play out.
All right. All right, wonderful. Since we are talking about rising prices and we are talking about inflation, another point of inflation which is going to hit people hard is the real estate prices, residential real estate prices, which have gone up substantially. In Greater Noida, 27% and above in just 1 quarter.
It's Greater Noida and Gurgaon both.
33% in Gurgaon.
But I think that is a good thing. I'll tell you why. Yes. There's more purchasing power in the people. That is why it is the 3 BHK houses that are going up.
Okay.
Not the smaller ones. So people who are looking for large apartments, that is where the demand has jumped up. And because the demand has jumped up more than 8% and the supply has gone down by 7%. more than 7%. That is why this 5.4% rise in residential prices for 3 BHK apartments. So it is, why I say it's a good thing, there is more purchasing power. People are looking for bigger houses. They're not looking for cheap 2 BHK or 1 BHK studio apartments. So probably people are earning more. And that is why,
I would say there is no more cheap 2 BHK or 3 BHK, Karthik. There are
definitely
no more
not in
cheap
urban townships, definitely not in metro cities. But I think I tend to agree. There is buoyancy, right? I think any kind of capital purchases, any large expenses being undertaken are reflecting that confidence that, okay, you know, I am unlikely to lose my job. If I lose my job, I'm going to find another job. I have enough skills and there are enough opportunities in the economy to keep me afloat and help me continue paying my EMI. So I think overall, there's nothing wrong in prices of real estate going up. If anything, it's a good positive for the economy because there is greater demand and lower supply. So by default, I mean, you know, the curve is going to tilt in favor of prices going up. So higher demand, lower price equilibrium would be met at a higher point in the graph. So it is going to continue to rise. Prices are going to continue to soar if demand continues to soar. But I think that pressure on supply is also going to be absolutely imperative. And you should have, maybe backed by this buoyancy of demand, you should have perhaps more developers, more real estate players coming in, completing their houses quicker, acquiring land, building more houses.
Adding to this, in the last decade, especially Bombay, there was a pressure on demand. There were unsold flats, and there were reports about this through the last decade. So now the pressures have shifted to supply. So probably that's obviously a good thing. So people have the money, but they don't have a house. The supply is not there.
All right.
So that's why
a limited supply means prices are soaring to a point where in Greater Noida, it is now more expensive to the point of 27% to buy a house. In Gurgaon, you have to spend 33% more to buy your dream home. But before we end this bulletin, World Cup frenzy is on us, and advertisers are paying through their noses, and happily so, to advertise during World Cup.
And why not, Shweta? Where else are you going to find a 1.4 billion strong population, all cricket fanatics, fans of all kinds tuning in to watch the World Cup matches? And World Cup incidentally commences today. So yeah, so a good day to sort of discuss this, that 2,000 crore rupees or $240 million worth of advertising is likely to get burnt in this 40-45 day carnival of the World Cup. Now, what are the spot rates? A 10-second ad, if you were to buy a 10-second ad during the matches, how much is it going to cost you? It's going to cost you 3 lakh rupees to burn 10 seconds worth of ad inventory. Look at all those big players who are going to advertise. You know, a 30-second ad is going to be 9 lakh rupees. You repeat it even 10 times over in a match, and 10 is a very small number. That's almost 1 CR burned. So, you know, I think it's a great opportunity for the media sector in any case, you know, which is always struggling to find sources of revenue. Festivals like World Cup are absolutely there, sort of, you know, milking cow, go for it and do not leave it until you've sucked out the last drop from every advertiser out there. Now, who are these advertisers? That is an interesting story. You know, you of course have your global advertisers, the likes of Coca-Cola or Google Pay. You know, these are companies which are likely to advertise. But deep pockets, and the consumption is not just India. You know, if you look at the entire consumption in Europe and the Oceania region, you will have close to about 1 billion odd eyeballs that get that see your messaging through advertising. But I think the shift that we are going to see apparently this time around in the World Cup is that your traditional brick and mortar brands are going to advertise. So you will have your auto brands, you will have your smartphone brands, you will have perhaps your HUL consumer product sort of brands advertising. But who will not be advertising this time around? EdTech is not advertising. Online gaming is not advertising. So these are sectors. These are sectors which are facing the heat at one level from GST, at one level from their own governance issues and liabilities and regulatory issues. But the traditional advertisers are back. The traditional advertisers are going to pump in money, and good news, good days ahead for broadcasters and digital rights companies who are hosting the World Cup.
Right.
For the gaming industry, the ironical thing is it's a gaming industry that's sponsoring the Indian cricket team, Dream 11.
Yeah.
So probably they should hit jackpot. And apart from the money, this is the time when you will see some of the best advertising probably. I am taken back to the 1990s when Coca-Cola got the official rights for the World Cup. And Pepsi came out with a campaign, nothing official about it.
Nothing official about it. 96 was it, right?
96,
I think 96.
So,
So it is money and the creativity, the juices are just gonna flow.
All right, so you've got an ad war upcoming as the Cricket World Cup starts here in India. We'll keep tracking all those updates for you on Newsline. But with that, it's a wrap on this bulletin. Thank you very much for watching.
China won't let us rest easy on our border.